Hey everyone, this is a Barclay Damon live broadcast of the Cyber Sip, practical talk about cybersecurity. I'm your host, Kevin Szczepanski. Let's talk. Hey everyone, we're back again with Yosha DeLong, Senior Vice President and Global Head of Cyber for Mosaic Insurance, a next-gen global specialty lines insurer. Welcome back to Cyber Sip, Yosha.
Great, thanks.
So, in our first episode, we talked about the origins of the cyber market dating back to the late 90s and early aught years of this century. We talked about how you got involved. We talked a little bit about underwriting and how cyber underwriters help organizations improve their cyber hygiene, even as they apply for insurance. Today, I want to shift focus, if we can, and talk about the future of cyber coverage and to sort of ask you your thoughts on where the market is heading today. I know you're asked about that all the time, but that's sort of it. The question, like, where are we going to be in 5 years' time?
Yeah, no, and it's fun to think about because, where are we gonna be in 6 months?
Right.
Where are we gonna be in 3 years? Where are we gonna be in 10 years? There's just so many different directions that the cyber market can take, and we're seeing threats change, literally on a daily basis, and, what's going on with the threat actors changing on a daily basis. So, Condi is one of the top ransomware gangs, and there was a announcement that I read yesterday that they're actually somewhat shutting down and splitting up. So what's that going to mean? And what does a fractioning of a gang mean? Is it going to mean that there's less policing of their people and people are just going to go rogue and go out on their own, or
Right.
does it mean that we're going to see some people that are getting out of it now and less bad actors? We don't really know at this point in time, and that could be a something short term that we do see in the next play out in the next couple months. When you look at insurance products and our response to those types of threats, I think we have built an insurance product, which we talked about last time, that was really in response to a very particular type of event that was happening in the early 2000s around privacy. And if you still look at some of the old policies, that's what they are. They're called privacy forms.
Right.
And so when you think of the threats that we have now, we continue to add to these policies to address the threats that have come along and the impact that it's had on businesses, in order to properly make sure that they do have some financial backing to these types of events. But when we look at how they're going to change in the future, is the format we've taken right now, is this continuing, Frankensteining of a privacy policy going to be the right way to go? Or do we come to a point where we just scrap everything that we've done in the future and or everything that we've done in the past and start looking at the future as a completely different product? And I keep thinking that that's what's going to happen, especially as we have been over the past couple of years looking to remove the cyber exposure from property policies, from casualty policies, and those exclusions continue to get broadening, and there is more demand to have clarification around whether or not you are covering cyber in various policies. There are gaps in coverage right now, and we don't really have great solutions for that. Does a policy just become completely bespoke where, I'm talking to some of our national accounts clients and they're saying, well, I don't need this and this. I just want to focus on this, or I just need this. And so are we completely going to be just manuscripting policies for everyone out there? There's lots of different directions it could go, but I think that's really exciting because that's
Right.
opportunity for all of us. And, you don't always get that in the insurance industry. So,
No, you really are on the cutting edge. A couple of things you mentioned, I wanted to walk back to, and you were talking about property and some of the, I think it was professional lines policies where there is this silent cyber coverage.
mhm.
Can you talk a little bit about that? Because I
Yeah.
think, on one hand, very creative and excellent policyholder coverage lawyers will do their very best to exploit those gaps and vulnerabilities in a policy for the benefit of their clients. We understand that. Truth be told, I'm on the outside or the opposite side of that. I'm the one fighting against that, but I respect it. Part of the concern I have with silent cyber is that in one or a few claims, the policyholder may win the battle, but
Mhm.
ultimately it's going to lose the war because these gaps are going to be closed. And if the policyholder doesn't have a standalone cyber policy, they may be left bare when something really bad happens. Can you talk a little bit about silent cyber as a risk in the market today?
Yep. Yeah. I mean, it's something I've been dealing with the past 5, 6 years. I think it's there's lots of different ways to take it. And there's some policies that are, what we call silent on cyber that actually intend on covering a cyber event. So, for example, workers' comp, which is highly regulated, and the forms are highly regulated. Um if a hacker hacks into a manufacturing plant and they take over a robotic arm and that robotic arm swings around and, you know, injures somebody, that workers' comp policy is still going to apply because it is there to address, a worker getting injured on the job.
Right.
There is not the ability to say, okay, we're not going to cover it because a cyber attack actually caused it. So, those types of policies, auto policies, which are highly regulated, if somehow a hacker was able to get a hold of somebody's car, which cars are moving computers in this day and age,
Yeah.
and disable the brakes remotely and causes an accident, that's still going to be covered under your auto policy. Where there has been a lot of discussion around silent cyber is whether there's areas that we really intend on covering based on kind of antiquated policy wording. So the
Hmm.
focus has really been on the property space, a little bit in the casualty space as well, but I would say mostly in the property. What constitutes property? What constitutes physical damage? Is damage to data damage to property? When a server gets fried, or somebody's entire manufacturing plant gets fried, should that be covered under property policy, or should that be covered under cyber policy? So this is really what the industry has been struggling with, and there's been a lot of wordings have been pushed out. Lloyd's is really good about pushing out LMA wordings that provide some market guidance, and saying this is how we should be addressing it. But then it's also leaving gaps of the cyber policy, cyber market just isn't quite ready to step up and say, okay, yeah, we're going to cover those property damages when they're not covered under property policy, or we're going to cover that third party, liability when it's not covered under a liability policy. So all of us in the market working together to say, this is what we intend on covering. And I do think there's certain aspects that property should cover, but they need to add clarity around their wordings on what they're covering and what they're not. So the way I always say it, and I've been working on lots of different coverages and lots of different policies for years, is we need to make sure that we ring fence it, define it, we're charging appropriately for it. We're explaining it to the brokers, explain it to our lawyers that are doing coverage work, so that they're able to explain it to the clients, because nobody wants surprises, and we don't want policies to end up in litigation. Even when,
Right.
like you said, even when the insureds win these things, they've spent tons and tons of money on these cases, and that's not the direction you want to go in. You really want to look for clarity and market certainty in the policies.
Right. So one of the things that has helped the casualty industry, I think, over time, is standardized forms.
Hmm.
ISO has provided those for decades, and though they have evolved over time, you have a lot of carriers using very similar language. So the market gets used to that and has standard definitions you mentioned. Um, do you see anything like that on the horizon for cyber? I was once in an advising conference, and a very knowledgeable and funny gentleman was speaking and saying, comparing cyber policies to each other is not like comparing apples to oranges. It's more like apples and hand grenades.
Yeah.
It's just they're very different forms, very difficult for the market to digest and understand. Is there anything coming on the horizon that may make that easier, or do carriers simply prefer to have their own tried and true language?
Yeah, I mean, what we have seen is that the latter. The carriers prefer to have their own language, but that doesn't mean that we don't, continue to have that conversation, and the common language conversation. I've worked with the Geneva Association on it. I've worked with the U.S. Chamber of Commerce when we've lobbied for some of these things to go through government and say, let's set some standards, and if we take the standards and we can kind of go from there. I think the challenge is the continuous threats, and
Right.
really, the market itself is so large, and so there's going to be carriers that are very established carriers that really right like the lower part of the middle market, and the threats that they're going to experience in that, and maybe the types of claims they're seeing, and the remedial actions that need to be taken are going to be very different than maybe a carrier B that's over here that's writing national account space on a primary basis. But I do think that there needs to be a focus in the market about simplifying the way we word these and really being very straightforward with how the coverage is going to play out in an event. And when we started Mosaic, I pulled up, 7 or 8 of my top competitors' policy forms. I mean, apples to oranges. We're talking about like, a pineapple and, a cherry. I mean,
Right. Right.
it's like some of them are written to address events
Hmm.
and some of them are written to address the outcome of events. I mean, it's not even like the
Right.
way that they flow goes the same. So it's very interesting, but they're all out there in the market, and clients have different preferences for that. So maybe that's going to continue just because that's the way clients like it, and there's different segments that are going to appeal to different segments of clients.
Right. And frankly, I don't mind that. I don't mind the free approach because
Yeah,
it frees up companies like yours to go out and compete on the strength of that different
right.
language.
Yeah,
And you're going to be competing in an ever hardening marketplace, right? So let's talk for a bit just about what it means that the market is hardening right now. And then I wanted to talk with you a little bit about some of the ways in which coverage is contracting, and then maybe some of the ways in which it is expanding at the same time.
yeah, really looking at how the market got into the position. We started seeing a shift, I would say, towards the end of 2019. But when I have this really great visual PowerPoint that explains this, but I think I can do it just orally. So we saw, 2015, a lot of claims that were coming out of data breach claims, and
Right.
last time we spoke, I mentioned, Target and Home Depot were two of the ones that people were really talking about. We saw a bit of a spike. Then we also saw increase in people buying coverage.
Right.
Um, After that, probably around 2016, we started to see the prices being driven down a bit because people were like, oh, well, this is a really interesting coverage. We want to be in this market. And the loss ratios prior to those events were very, very good. So, people, okay, we can make money. This is a
Right.
catastrophic coverage. It's
Mhm.
only going to happen to these types of companies. It's only going to happen to companies that have credit cards and have
Mhm.
consumers. So people, we went from, I think, like 23 carriers to like 200 carriers in the cyberspace in a
Wow.
matter of a couple of years. So
It's
as
an
you increase
explosion.
you increase
Yeah.
the competition, it's driving down the price.
Mhm.
At that same time, we were seeing an increase in threats that was really expanding the coverage. And, the biggest one was really business interruption. So you have an event and your business has to shut down. What revenues have you lost as a result of that? There's a lot of other factors in there, but that's a very basic way to explain it. So that was the expanding coverage, and then other things started getting layered on top of that. And as those coverages expanded, there wasn't necessarily a upload in the premium to result from that. So you were
Right.
kind of expanding the coverages, premiums are coming down, and then we saw the ransomware start to increase, and there was a collision really of, we cannot continue to make money off this. We were looking at these as cap policies. We were looking at these as high severity, low frequency.
Right.
Ransomware completely turned that on its back. And now we're seeing frequency where I was hearing in the market, people were saying, oh, we're seeing 100 claims a month out of ransomware. We're seeing 200 claims a month, where in the past they've been seeing maybe 5 or 6 cyber incidents a month.
Wow.
So, the strain on the carriers was huge, and the costs were huge, and the forensics firms costs were going up, and there weren't as many forensics firms in the market at that time as we see now. So it was really a kind of a perfect storm that happened, and the market basically said, this is unsustainable. If we don't do something, we're not going to be around in the next 5 years.
So, what did the market do? Did companies get out of the business? Did they tighten their underwriting requirements? And if so, how did they tighten those underwriting requirements in a way that made the risk more palatable to underwrite?
Yeah, I think, I would say three big things. We were kind of moving towards asking less and less questions. And I remember going out to brokers and they're like, well, this market only asks three questions. They ask for their name, address, and website, and they can underwrite off that. That stopped happening. So, that plays into the way we underwrite, really looking at the controls, what kind of controls they have, how they're going to recover from event, how they're going to prevent an event from happening in the first place, things that are particular to their industry as well. Healthcare company is very different threat than a retail company, which can be very different than the manufacturing. And is this manufacturing highly automated versus non-highly automated? They need to have different controls in place, but there's still like a minimum set of controls that everyone should have in place, no matter what kind of information you have, and no matter what you do in your industry. So there was a focus on that. The other thing was really the capacity. And we definitely started to see this towards the end of 2020. But, when we opened shop in Mosaic, it just happened to be the perfect timing for us because there was such a shift in the market and there was a need for a new player.
Right.
Which was, we just kind of slid right into that by accident. But I'm definitely
Good accident.
very happy that it happened. Yeah.
Yeah.
So, carriers that were offering $25 million in limits all of a sudden said, well, we don't want to have this much exposed to one event. So we're going to constrict that down to tens. And then it was, we used to say tens, 15s are the new tens, oh, well, now people are only offering fives. And we were getting, as soon as we opened our doors, we were getting all these calls from brokers that are just like, we just need you to fill a hole. If it's either yes or no, name your price, fill the hole. We need the capacity.
Mhm.
So we didn't really see markets leave the industry, but those were the two biggest things. And I would say the third factor was really looking at the companies and how much they were willing to take themselves. So really looking at their SIRs, their deductibles. We saw those go way up, especially in the national account space. But I would say even in the SMB space, where we started saying, okay, rather than a $500 deductible or $1,000 deductible, you need to have a little skin in the game. You need to
Right.
show us that you're committed to preventing these events. So, you need a $25,000 deductible. You
Mhm.
need this to sting a little bit if it happens so that you do everything in your power to make sure it doesn't. And you don't just see insurance or risk transfer as a replacement for actually paying attention to your cybersecurity.
No, and as difficult as I'm sure that was for the industry to react and adjust to, I think in the long run, that is one of the things that has led the industry, the policyholder side, to become more focused and more responsible when it
Yeah.
comes to cyber hygiene. Because $25,000 is significant. I mean, that could I know the IBM and Ponymon have their reports of the costs of a annual cost of a data breach, but really quite a lot of those expenses can fall within that deductible. And
Mhm.
if you've invested in that ounce of prevention, you're going to save yourself from what could
Yeah, and
other.
that's another good point. I was talking to brokers like 8, 9 years ago, and they were really frustrated that their clients that did invest in their own cybersecurity and did invest in making sure that they were doing everything right, they felt like they weren't really getting credit in the market
Yeah.
for that. And they were
Mhm.
kind of, these brokers were like, well, why is my client going to invest in this if you guys aren't acknowledging that? And now we're acknowledging it, and there is price difference, but it's also, you might not be able to even get the coverage if you don't do these minimum things. But then when you are doing the right things and you are committed to preventing these events and you are committed to working with your carriers to make sure that they're a partner through the process, you get priced accordingly, and that's the way it should be.
Right. So far, we've talked about some of the ways in which the coverage has financially contracted. And by that, I guess I mean premiums go up, limits go down. There's more excess layering in the process to achieve what could have been achieved just a few years ago by a single carrier. Talk to us about some of the other limitations or exclusions that you've seen in the coverage over the last 1 to 2 years. I know that there is special emphasis these days on what has been called a systemic cyber risk, so that many carriers are taking a much harder look at a loss that may arise from a systemic ransomware operation as opposed to a smaller one-off that may be more palatable from an underwriting standpoint.
Yeah, and I think that's probably the biggest one. But when we started to see these shifts in the market and the constriction of limits, I personally did expect to see huge shifts in the wordings. And that didn't happen. It was more where we saw some constriction and some people saying, okay, we need to tighten this up or clean up this wording, or we need to, one of the big ones was for a long time, we were looking at the potential of third party loss upstream and downstream. So
Right.
you have somebody who's providing a service to you, and they have an event, and that affects your business and your business's ability to operate. Then the insurance policy would apply, and then on the other end of that, you have an event and your supplier can't function, and then they sue you, and the policy responds to that. So we kept seeing that getting expanded, and so that was one area that we saw quickly uh, constrict, but it was more about what defined a service provider rather than the coverage just completely going away. So the wording got really broad, like, anyone that you had a material dependency on or something along those lines, to either naming, we're going to name these three critical suppliers, and then the underwriters can kind of underwrite them to a certain
Right.
extent and realize where their accumulation could be, or, saying like it's only this type of service provider. So that was one area where we did see, I would say it was more of a clarification. While it was a tightening of the wordings, it was really a clarification, allowing underwriters to get really their hands around what they were actually covering. But the systemic event has been a huge topic of conversation. And ever since, the WannaCry not Petya incidents,
Hmm.
2016 and 17, we realized like one of these large scale events could really be detrimental to the insurance industry, and
Right.
detrimental to the insurance industry, the reinsurance industry. And
Because
then,
you're talking about a
exactly.
global risk. Yeah.
Yeah, yeah, and and reinsurers don't just reinsure cyber; they reinsure other things too. So that could result in hardening markets across other lines of business as well, just based on the financial stability of these companies. So there's been a lot of conversations around what do we want to cover, what do we not want to cover, how do we continue to make sure that we are sustainable for the future. And every time one of these events happens, SolarWinds event, a Kaseya event,
Hmm.
they are large scale, but they're not large scale on like where they're going to impact the entire industry. But we start to say, okay, this is what could happen, this is what could happen, how are we going to put controls around this? So there's lots of ways that you can underwrite to those types of events, and that's really how we're building our portfolio, is looking at diversification across industries. So if I'm not 100% concentrated in dentist's office, then the
Right.
dentist's office software that goes down isn't going to, completely blow up my portfolio. And so, looking at what companies' dependencies are and making sure that you have diversification across your portfolio. But as far as wordings, the industry's really been looking at how we address that, and there is a market out there that put out a systemic event wording and kind of trying to control that. And I think that it's really driving the discussion, and whether or not it's the right way to handle it is going to be determined by the applicability of it and the longevity that we start to see in the market. But it's moving in the right direction as far as addressing the problem, and then it's really going to set the stage for other people to say, do we think that's the right direction, or do we want to handle something different? Which leads us all the way back to the beginning of our conversation of we could have
Right.
15 different versions of
Right.
ways to handle this in the next couple of years.
Yeah. So you were talking about some of the large scale events that did not have the global impact that perhaps some had expected or that they might have in a
Hmm.
different context. And I know you've talked recently about the Russia Ukraine war, and we're all aware of the potential cyber risk. I don't think a lot of people fully appreciate the scale of the cyber attacks that are going back and forth between those two nations right now. Is that an example of one of the events that the industry is concerned about
Oh yeah.
becoming global? Can you talk to us a little bit about that? Because I think the way this was reported in the media, we were all we were expecting there to be a full-on cyber crisis when the war began. That didn't happen, and I feel like we may not be paying careful enough attention to what's really going on, may not be fully prepared for an explosion in this risk.
Yeah, I think, cyber war, we could do a whole nother episode about
Yeah,
cyber war.
good.
It's a very interesting topic, and how the industry is looking at it. We've been doing a lot of work around really defining what we do want to cover and don't want to cover in that space, and what constitutes cyber war, what cyber war could turn into. But I think, explicitly with the Ukraine Russia situation, it's a horrible thing to watch unfold, and I think the humanitarian crisis that it has caused has just been
Yeah,
absolutely gut wrenching. And knowing that cyber is one of the warfare tools that is being used right now, on both sides, is really interesting to watch. And we have seen it. It may not have been as well reported, but there's been some pretty severe incidents on both sides, that have tried to take down critical infrastructure, that have tried to really damage the way that people operate and live their daily lives. These types of things. One of the most interesting things that came out of this is that, a lot of the bad actors that were working together in these gangs had members in both Ukraine and Russia.
right.
And it caused kind of a division of them having to declare their loyalty. And we actually saw some of the major gangs divide up, and some fractions cause, which could have actual implications where we saw a bit of a decrease in ransomware elsewhere at the beginning of this. And in talking to the people that are kind of on the front lines with this kind of stuff, they said, well, this could either create an opportunity where we see somebody else like a Iran or a
Right.
Iran or a China step in and say, okay, there's a vacuum and we're going to take advantage of that. Or it could be a situation where they're going to be, because Russia's spending so much money on this war, they could be more motivated to start to commit ransomware events to help fund the war. We haven't really seen that yet, but there is, in Russia in particular, it's not a highly organized government run operation, not like what we see out of China or North Korea. So it's a little bit more of a government allowed type of thing, and the government can induce them to commit certain crimes and have the financial kickback from that. But I think there's still some stuff to come out. And like you said, I think we're going to be looking back on this, probably in a year from now, and there's going to be things that we're not aware of right now that are going on. But then the other huge concern, and we saw this with the not wanna or with not Petya, was it was Russia attacking Ukraine, but it got out of the country. And
Right.
so that's what we keep talking about is, we want to make sure that our insureds that have nothing to do with those two, but have some connection to a Ukrainian company, if they somehow are impacted by a direct thing, so we call it an indirect attack because
Hmm.
they're not the direct target, they should be covered in most cases, subject to policy wording, of course. And this shouldn't be something that we really are looking to exclude, unless we have been very explicit in the policy that we want to exclude it. So we're really looking at making sure that there's clarity around that. And there's a lot of projects going on in Lloyd's right now, around what war should mean and where we don't want to, as an industry, be covering war exposure.
No, I think that's critical. And what I'm hearing as you're talking us through this is the risk of a spillover effect. So
Mhm.
if you're a Ukrainian company, then you may be doing business with a Ukrainian company, and if it, and as that web
Yeah,
expands, you could have businesses in the United States, for example, that have only indirect connections
exactly.
to Ukrainian or Russian businesses, but they will be affected if there is an attack on one of those directly affected organizations. So
Yeah,
very
but that
interesting.
goes back to our cyber hygiene, and if they're doing the right
Right,
cyber hygiene things, then, they have that backstop.
right,
Patching's a huge part of that. Patching's a huge
right.
part of that.
No, critical. And it's amazing that in 2022, we're talking about some of the very same elements of cyber hygiene. And we're talking
Yeah.
about multi-factor authentication, smart passwords, patching. I tell clients sometimes, if you do three things, if you do those three things, you will be
Yeah.
50 to 80% more secure than you
Yep.
are now. But we do still see clients coming to us suffering from attacks, and we say,
Yep.
well, do you have multi-factor authentication? And many are still not in that position. It sort of speaks to the challenge of the industry. Well, before we go, and you've been so kind to spend this time with us today, I want to ask you about some of what I'm calling expansions of coverage. Some of these have been around for a little while, but I want to talk a little bit about the three B's, I guess:
Yeah.
contingent business interruption, which you were talking about earlier when
Yeah.
you were mentioning vendors who may, if I am a food manufacturer
Mhm.
and my spice supplier suffers a cyber attack, am I covered for the loss of business? That's sort of a CBI claim. And then I wanted to ask you about bricking and betterment too.
Yeah.
Betterment, especially because that's been a gap in coverage over time that is starting to get filled. So, can we start with CBI and work through those?
Yeah, and CBI is something that we do see as a fairly essential coverage. But I think that again goes back to that clarity around what is covered and what isn't, and how we're looking at covering that, because CBI is really the greatest source of systemic event. Because if you have a vendor that's a vendor to multiple companies, which most of them are, they usually don't have one client,
Right.
and a vulnerability is discovered, that vulnerability can spread to all those different clients. So, that's really, while I don't expect CBI coverage to go away anytime, I think there's going to be some clarity around what the industry is looking to do. And it also goes back to us as underwriters making sure that we understand what those dependencies are on the contingent business interruption clients. So, what are you actually relying on them for? How important is this? And how many clients do we have in our portfolio that have vulnerability to this particular vendor? So,
Right.
somewhat on the underwriters to really start to look at some of those checks and balances on that.
That can greatly complicate the underwriting process, though, right? And
Mhm.
you alluded to it earlier with sort of perhaps limiting the coverage to key vendors, maybe two
Yeah,
or three.
yeah,
Otherwise, your underwriter effectively has to underwrite multiple vendors in order
yeah.
to get a real handle on the insured's risk.
Yeah, yeah, and I keep saying I was in London last week and having some of these conversations, and I always said I picture it like, the red string where we've got, okay, this client's got this and this client's got
Right.
this, and then we look at where the intersections are. Of course, I'm simplifying it way more because we actually have AI and computers that do all this stuff for us, and it's part of the modeling process. But it's going to be really important to realize. But I also think the industry is going to have to say, uh, at what point do you draw the line? Like, if I have a massive portfolio of primary carriers, and like, do I suddenly say, okay, I'm not taking any more carrier that has, a dependency on this particular uh, vendor, and then just draw the line like property does? And property says, okay, we're full, we have no more room for Florida, we're done. We haven't done that as an industry yet, so it'll be interesting to see how that develops as part of the underwriting process as we start to track some of this information.
It's an evolving process, and it evolves over such a short period of time.
Bricking was the other one you mentioned, which I think bricking is so interesting because when we were first writing these policies, bricking is essentially a piece of hardware getting so fried that it turns into a brick, and it's useless, and there's no way to really remediate that. And those can be quite costly. But when people used to have server farms on site and they held a lot of servers, that was our main concern, was really, what happens when all those servers get fried and all the data is lost, and you've got the data restoration costs as part of the policy. And then, but somebody might have millions and millions of dollars worth of hardware that's also
Right.
fried. Where we're starting to see this play out more is in the manufacturing industry, and the manufacturing industry, especially that's highly automated, using robotics, using things like that. They have a huge dependency on hardware that's not in the traditional form that you would think of, like a server or a
Right.
computer, but they're very sophisticated machines that can be quite costly. And that's where that really comes into play. And so, as an underwriter, if you're offering a coverage like that, you're really looking at what's my exposure to this particular insured, and that kind of determines, is this something you want to offer them? Do you sublimit it? Do they really understand? Are they really paying for the coverage and the exposure that's presented? So that's been one that's been interesting to see it evolve, because when we were first talking about this maybe 6 years ago, we're like, well, it's not really something that it's actually physical property damage, which is something we're not really
Right.
looking to cover.
True.
So, should that be covered under a property policy? And started to have those conversations again.
Finally, betterment, which
Yes.
has always been near and dear to my heart, because when I've had to explain to a client who has suffered a cyber incident that the good news is your forensic service provider, your carrier's provided this vendor to help you. They can go in, they can figure out who got in, where they went, what was exfiltrated or accessed, and they can help you fix the glitch. But if they discover that your system is deficient in some way, you're responsible for repairing or remediating on your own. Improvements were not covered for the longest time, but that
Yeah.
has changed.
It has changed. We've really seen it as something that's been advantageous to the carriers. So, if somebody breaks into your house and it's because you have a broken lock on your back door, your insurance company pays, they're not going to say, okay, well, good luck. We hope you get that fixed in the next couple months. It's really to our benefit to say, okay, we're going to either give you a small amount within the policy to pay for this and actually get these computer systems up to the level they need to be, so that we can close these back doors and close these vulnerabilities and make sure this doesn't happen again. So it is an advantage to the insurance company to know that that was done, and really be able to have some feeling that you can stay on this risk, because that now there is a minimum standard. But I would say it also comes into the underwriting when we start to look at legacy systems and how people are controlling their legacy systems. And
Right.
so, do we want to underwrite a company that has a lot of legacy systems or has a lot of outdated software and hardware? So that's part of the underwriting process, and saying, okay, there might be something that they have. Maybe it's offline. Maybe they have it because there's not any other company that can make this particular machine or whatever it is. But I think it really comes into play when we talk about medical devices, and we have yet to see where medical device causes a huge ransom event. Thankfully,
Right.
most
Not
companies
yet.
know how to ring fence those and keep those out of their network. But, that could be something where we say, okay, these things, there needs to be a more modern MRI machine put in here that can actually be patched, versus this one that you've had sitting around here for the last 30 years.
So it sounds like the risks are increasing, and while the market is tightening, the industry is responding by expanding coverage, clarifying coverage in the key areas to enable policyholders to manage and transfer these ever increasing risks.
Yeah, that's exactly it. And I think that clarification is a huge, huge part of it. The industry needs to be very clear about what we want to cover and what we don't, and making sure that the clients understand how to best utilize their policies, partner with their carriers, partner with their brokers, really try to become the best that they can at this, preventing these events, and understand the implications of an event throughout their organization. And those are really going to be key to the longevity of this market.
Well, I think that's a great place to leave it. So we'll leave it there. Yosha DeLong, thank you so much for joining us, and I really look forward to talking with you again on another episode.
Great. Thank you so much, Kevin. I really enjoyed this.
No, thanks to you, and thanks to all of you for watching this episode of CyberSip. We're back soon with another one. The CyberSip podcast is available on barclaydamon.com, YouTube, LinkedIn, Apple Podcasts, Spotify, and Google Podcasts. Like, follow, share, and continue to listen. This material is for informational purposes only and does not constitute legal advice or a legal opinion. No attorney-client relationship has been established or implied. Thanks for listening.